The fact that we had a 20% correction earlier this year kind of minimizes that risk of another massive correction this year. Those don't happen very often. 20% corrections only happen about 13% of the time historically, but a 5 to 10% correction happen every single year. So here's what you need to know before the bell this morning. I wanted to talk about a couple of things that are going on. The markets, again, on a variety of bases, there's some things that are getting pretty overdone here. And stocks continue to do well. And again, we're still seeing that negative divergence in relative strength, negative, kind of this negative divergence momentum. But we do have a very decent gap between where the market's trading and that 200-day moving averages. And when you get these larger gaps from moving averages, they act like gravity. So they want to pull things back eventually to that gravitational pull pulls it back towards those moving averages. And again, this is what happens and why we have these corrections. We get these big deviations, then markets have to correct back to the moving averages. That deviation's getting pretty large here. Now, it doesn't mean that you're going to have an immediate correction tomorrow. It just says that eventually we're going to close this gap. And we've seen this repeatedly over history. It's why markets go up and down. But eventually that gap is going to close, and that's about an 8% clip right now on the market. So again, there is risk of a correction, even though it doesn't seem like the risk of a correction is high. There is a risk of a correction, and that correction could be up to about 8%. Again, that would just be completely normal within the context of any given year. The fact that we had a 20% correction earlier this year kind of minimizes that risk of another massive correction this year. Those don't happen very often. 20% corrections only happen about 13% of the time historically, but a 5 to 10% correction happen every single year. So again, there is that risk of some type of correction here just because of that deviation we have in the market. And again, that deviation of a market rising versus a declining relative strength, that negative divergence is also at least something worth keeping a watch on. But I wanted to take a look at bonds here real quick because bonds have been doing exceptionally well. Yields have been dropping fairly sharply here. Again, we're approaching 4% on 10-year Treasury. We've broken down through all of these moving averages. All those previous resistance supports have been broken, taken out. We're on a buy signal on interest rates right now, which is technically inverted because this is interest rates, so you have a sell signal here. But that's actually suggests that you'll have lower rates here, at least near term. Getting pretty oversold on a short-term basis. Again, you don't get this oversold on a short-term basis for very long. So again, seeing a bounce in yields here, what would be ideal is a bounce in yields that brings us up to about 4.2% and then a turn lower and we take out some of these recent lows. But again, yields aren't going to go straight down. They're going to work their way lower over time with economic growth, but we're starting to build a much better trend. We've taken out all this long-term support in treasuries, in yields at 4.2. We took that out. That's why you had such a big break. There's a lot of shorts sitting right there that are now having to cover. So again, as we kind of work down here over time, you're going to get a bit of a bounce here in yields and then potentially another leg lower here. But again, if you take a look at TLT as an example, this has been a very, very big move. You've taken out all of this is TLT, which is the 20-year Treasury bond ETF, taken out all these resistance in these moving averages, moved up above that, but you're extremely overbought here. So again, technically, when you're this overbought, you're going to get some type of a corrective action across the board. We're seeing the same exact setup in gold. Gold has, I've not seen gold this overbought in quite some time, but it's had a very, very good move, very steady climb here after this long consolidation. Price of gold didn't really go anywhere for several months. Finally broke out of that. That's doing well, but take some profits here. Again, you're so overbought here that we're going to get some type of a pullback here before it can advance again. You just have to, again, these gaps from moving averages have to get resolved at some point, either through a consolidation or correction. So just kind of pay attention to that. Same thing we're seeing on Bitcoin as well, and it's something we're going to talk about today. Bitcoin's turned up positive on a buy signal. It's not overbought yet, but it's got a bunch of resistance here. It's got to work its way through. But this is a really good example of what I'm talking about. These deviations from these moving averages, this was a fairly big deviation from the 50-day moving average that we had previously, had to work its way back through that process, took out the 50-day, starting to turn up here a bit. But again, you're on a buy signal here at a decent level, not really overbought. So there's some room here on the upside for Bitcoin to try to climb back up here to about 120,000. But this is a really good example of these big deviations that occur between moving averages, and we've seen this repeatedly. When you have these big deviations, very overbought conditions, from moving averages, you get a correction repeatedly back to that moving average. So again, this applies to all asset classes. No asset class is immune from these technical cycles and kind of technical setups. So at least pay attention to that. Opportunities take profits, opportunities add exposure. Technicals is going to kind of help you work your way through that. That's what you need to know before the bell this morning.